Welcome to the second stage of this complete and concise Forex trading course by PIPSDIMENSION. Here, I'll be giving you tutorials on how to use the functional features of the MetaTrader 4 to perform your trading activities. So at the end, you can actively use the features on the trading platform to perform your technical analysis and also make your buy and sell orders. After that, on the chart window, I'll be showing you how to identify some useful chart patterns and some useful candlestick patterns. I'll be showing you how to apply the Fibonacci tool on the chart and then the use of some technical indicators. Alright, the other different trading platforms apart from the MetaTrader 4, we also have MetaTrader 5. So that is an advanced version of the MetaTrader 4. We have NinjaTrader, TradingView, Pro Real Time, among others. But in this tutorial, I'll be using the MetaTrader 4 because, it is easy to use and that makes it more appropriate for beginners. Besides, it is provided by almost all Forex brokers. It is featured with the useful tools and indicators for your technical analysis, and it is free of charge. Now, before you can get on the trading platform, you need to create an account with a Forex broker. After that, you go to their website and download the MT4. They also offer you the mobile app version. So I'll be giving you tutorials on both the PC and the mobile versions. But for a beginner, it is advisable to start practicing on the PC version for more convenience. Now, let us open the MT4 and log in into our trading account. Alright, to log in, click on the connection area at the right bottom corner of the trading platform. Enter your account ID, your trading password, and the server name provided by the Forex broker. Good. This is the interface of the MT4 trading platform. Now, let us look at the general features on this interface. Here is the chart window, which displays the changes in prices of the currency pair along with the time period. So you see, this is the chart for the euro-dollar pair. This is the chart for the pound-dollar pair. You can maximize any of this chart to get a clearer view. And this is the market watch, displaying a list of currency pairs in the Forex market along with their respective bid and ask prices. This toolbar is made up of objects, indicators, and other various options for your analysis. This navigator here gives you something like a tree to navigate through your sequential actions. At the bottom here, we have the terminal, which displays your trading orders, both the trades that are still running and the pending orders. It also gives you information on your account history, news, market, where you can purchase some indicators, among others. To open a chart of a currency pair, let's say the Euro Pound, right-click the Euro Pounds from the list on the Market Watch and select Chart Window from the pop-up menu. Sometimes you may not find the list of all the currency pairs in the market. In that case, you have to click on the space on the Market Watch and select Show All from the pop-up menu to display the full list of the currency pairs. And you can manually select some hidden commodities that are not currently showing in the Market Watch. To do that, right-click on the Market Watch window and then select Symbols from the pop-up menu. After that, you have a display of other commodities such as the cryptos, energies, indices, stocks. Okay. For instance, if you want to trade a different commodity like the US oil, oil falls under the energy category, so you select the energies. Then you select the US oil to be displayed among the current legs on the Market Watch. Okay, you may like to change the appearance of the chart window for your convenience. To do that, right-click on the chart and select Properties from the pop-up menu. And then you have the chance to make changes in the color scheme and others like the background color, the foreground color. For me, I would like to maintain the background color and the foreground color as white. Perhaps I'm only interested in my candlesticks, so I'll change my bull candle to gold and then my bear candle to something like the blue violet. Also, I would like to make changes in the bar up and the bar down colors so that they can match the colors of my bull and the bear candles respectively. So you can make some changes here according to your own preference. After that, you click on OK to have a whole new appearance of your chart. At the top on this toolbar, you can also change the candlestick chart to the bar chart or the line chart. But in these tutorials and technical analysis, we are going to apply more of the candlestick charts. After you have successfully made changes in your chart appearance, you can save it as a template so that you can easily apply the same appearance on a different chart. To do that, you right-click on the chart, select template, and then you click on Save Template. Here you can save it with any name of your preference. For me, I would like to save it as Fresh Setup. After that, I'll click Save. Okay. So now it's easy to apply the same appearance on a different chart. Just right click on the chart and then you select templates. Now you select from the list of the names the one you used to save. For me, I use Fresh Setup, so I'll click on Fresh Setup and then yes, the new chart has changed to my preferred appearance. You can also change the time frame. The time frame is simply the period it takes for the formation of every candlestick on the chart. So if you select the 1 hour time frame, it means each candlestick represents the price action within a 1 hour period. 4 hour time frame means that each candlestick on the chart represents the price action within a period of 4 hours. So you would like to change the time frame according to the trading style you are using, depending on whether you're a scalper or you're a day trader, swing trader, or a position trader. That will determine the time frame you'll be using most in your technical analysis. So in a nutshell, what I mean here is that for 1 hour time frame, each candlestick represents 1 hour of price action. For 4 hours time frame, each candlestick represents 4 hours of price action. So the trading platform features from the 1 minute time frame up to the monthly time frame. So to change the time frame, you quickly go to the toolbar up here and select the time frame you prefer. Alternatively, you can right click on the chart and move your cursor to select the time frame on the pop-up menu. On the chart, you might want to look at the price action in the past, especially when you want to backtest with your trading strategy. To do that, just click and drag the chart backwards. But sometimes in the process, you realize that the chart automatically scrolls forward again whenever there is a new change in the current price. You can deactivate this automatic scrolling by clicking on the scroll to end option on the toolbar. You can also select the option next to that to shift the end of the chart from the right border. The platform provides various objects for making technical analysis. For example, with the crosshair cursor, you can click and drag to select the difference between 2 points on the chart. And there appear 3 numbers. The first number represents the number of periods or the number of candlesticks within the 2 selected points on the chart. The second number represents the difference in the number of pips between the 2 selected points. This is written in a fractional pips known as the pipet. So to know the number of pips, you just ignore the last digit. For example, if you see 573, it means that the difference between the 2 selected points is 57 pips and 3 pipettes. And the last number is the price at which your mouse cursor is from the start of the crosshair. So on the toolbar, you can access some other objects like the trend lines, Fibonacci, among others, for your technical analysis. Moreover, you can make changes in the kind of object to be displayed on your toolbar. Just right click on your toolbar and select Customize. So from the pop-up menu here, I can decide to select some new object to be displayed on the toolbar. For instance, let me select this object, trend line by angle. After that, I click on Insert. Also, if you don't want to see any object on your toolbar, you can just select the object from the list here and then you click Remove. MT4 also provide various indicators that can assist you in your technical analysis to make more correct predictions in the market. To apply an indicator on your chart, you can select the indicator options on the toolbar. Okay, here I'm going to apply the 200 simple moving average indicator. So I'll click on the indicators option, select trend, click on moving average, and then in the options here, I enter 200 period among other features, and after everything, I click OK and the indicator is applied on my chart. Now, you can view your applied indicators from the indicator list options, and then you can decide to make modification or even delete the ones that you no longer want to see on the chart. Now, let us go to the most important objective for these tutorials on the trading platform: how to place a buy or a sell order. First of all, you need to make sure you have opened the chart of the currency pair you want to trade. Now, to place your order, you select the new order option on the toolbar, and then you select the volume or the lot size you want to use for the trade. So you can see from these options a list of different lot sizes, from the standard lot to the mini lot to the micro lot sizes. As we learned from the beginner lessons, 1.0 means one standard lot size, which represents 100,000 units. So if you choose this one standard lot size, that means every pip that you make or you lose is going to be multiplied by 100,000, and the value will be converted into your trading currency and added onto your account. With that said, 2.0 represents the 2 standard lot, which is 200,000 units. You can also see from the list here mini lot sizes, that is in the first decimal places. 0.1 represents 1 mini lot size, and that is 10,000 units. 0.2 represents 2 mini lot sizes, and that is 20,000 units. And we can also see the micro lot sizes, which represent 1,000 units. So 0.01 represents 1 micro lot, that is 1,000 units. 0.03 represents 3 micro lots, and that is 3,000 units. So here you choose wisely according to the trading capital in your account. For example, if you have a trading capital of 1,000 and you select one standard lot size here, that means every pip change is going to be $10. In that case, if you lose 100 pips or you gain 100 pips, that will be equivalent to gaining or losing $1,000. So it will not be prudent to choose a standard lot size for a $1,000 account. 100 pips is easy to gain or lose on a currency pair in just a day or two. So if you are choosing a standard lot size for a $1,000 account, it means you are risking losing all your capital in just a day or a two. And this turns out to be more risky. But if the trade goes in your favor and you are making profits, you can just make $1,000 profit with just 100 pips move. So it's like you risk more to gain more, but it is not advisable to be risking more. No. Proper risk management or money management goes with reducing your risk on every trade that you take. With regards to that, for a $1,000 account, it is more appropriate to use a mini lot size, or better still, a micro lot size for a single trade. in that case, it's like you risk less to get less, and that is a proper way to trade in the forex market, because that will give you more room for trading opportunities in the market. But the good thing here is that if you have a profitable trading strategy, you can be risking less with small amount of lot sizes, but at the end of the day, you can gain more profits on top of your account. I'll be giving you more guide on this in the advanced lessons of this course. After selecting the lot size, you also have to select the type of trading order, that is whether it is the instant market order or a pending order. If you select the instant market order, that means you are going to buy or sell at the current available market price here. After that, you can then set your stop loss target and your take profit target, enter the instant order. Remember, we buy to make profit when the price rises above your entry level, and then we sell and make profit when the price falls below your entry level. Now, I'm going to be talking about the pending orders. That is the limit orders and the stop orders. So usually we use the pending orders when we want to be away from our trading platform. So we set the pending orders so that the trade can automatically trigger even when we are offline. We use the buy limit order when we want to enter our entry price at a level that is below the current market price. So for instance, you make your trading analysis and per your prediction, the price will start going up after hitting this level below the current price here. In that case, you have to select the buy limit order option, then you set your volume and the stop loss, take profit, and then you enter the pending order. So this trade will not be triggered until the price moves to hit your entry level that you have set. After your buy limit order is triggered, you'll be making profit as the price goes up above your entry price, and similar goes for the sell limit order. We already know that we make profit on a sell limit order when the price falls below our entry level. But we use the sell limit order option when we want to set our entry price at a level that is above the current market price, so that we expect the price to move up to hit our entry level, and then when it bounces back down, you can be making profit since it is a sell trade. Now, the pending stop orders is opposite of the limit orders. In this case, so when do we use a buy stop order? For instance, per your predictions by your trading analysis, you realize when the current price moves from the down here to a level up here, it's going to continue upwards, which means you would like to buy at this level at the top, but maybe you would like to enter a pending order so that automatically the trade will trigger even if you are offline. So what you do is you enter this higher price in the buy stop order option. After that, if the price moves up to your entry level, it will automatically trigger even if you are offline. And then when it continues upwards, since it's a buy order option, you're making profit. On the other hand, we use the sell stop order option when we want to set our entry point at a level that is below the current market price, so that when the trade moves down to hit our entry point and continues downwards, we're making profit. Okay, after you have successfully placed an order, whether it is a pending order or an instant order, you can view the feedback of your trading order on the terminal down here. Alright, so now that you know the functional features of the MT4 on the PC version, let me take you through the similar features on the mobile version. So over here, you can find the list of the currency pairs in the market. So to open a currency pair, you tap on it and then you select Open Chart from the pop-up menu. So you can use the icon which looks like a clock at the top here to change the time frames of the charts. If you want to select an indicator for your chart, you can use this chart here and you can view all the indicators on the trading platform. To make a selection of a technical object, you tap and hold the chart and then you select this icon right here to display the list of all the objects on the trading platform. To make a trading order, you use the plus sign at the top right corner here. So here you have the instant order execution and the other various pending orders. Alright, in this lesson we are going to look at some useful chart patterns on the price chart of a currency pair. The use of chart patterns makes a very big part of technical analysis. So, knowing how to apply chart patterns in your trading strategy can help you identify more accurate entry and exit levels on the price chart of a currency pair. That is, to study and identify some particular patterns formed by the prices for a period of time will help you predict some key levels to buy or sell on the chart. Therefore, I'm going to show you how to identify some of these useful chart patterns and then how to apply them in your trading strategy. With that said, let us start by how to identify the trend, support and resistance levels. A trend is simply a particular direction that the price of a commodity takes for an apparent long period of time. That is, when the price is going up, we say it is in an uptrend. On the other hand, when it is going down, we say it is in a downtrend. Sometimes the price is neither going up nor going down. In that case, we say we are in a sideways trend. Or you can say the price is ranging or the price is consolidating. In trading, there is a popular saying that the trend is your friend, meaning there is high probability of making profit when you are trading along with the trend. That is, you need to look on the price chart and identify whether the trend is up or down. So when the price chart is indicating an uptrend, then you need to be looking to make buy entries. But when the price chart is indicating a downtrend, then you need to be looking for sell entries. And when the chart indicates that the prices are neither trending up nor down, then you can be looking out for either buy entries or sell entries. Now, how do I identify on the chart whether the price is in an uptrend or downtrend or a sideways trend? On a wavy price chart, this is how you can identify the trend. You look out to locate the high price levels, and then you also look out to locate the low price levels within some considerable period of time. After locating the high points and the low points, you can use the trend line tools from the toolbar to connect the highs and also connect the lows. And this will create what you call a channel. So you can look at the direction of the channel to tell whether it is in an uptrend, a downtrend, or a sideways trend. For an uptrend, you can see that every consecutive high is higher than the previous high, and you can also see that every consecutive low is higher than the previous low. So an uptrending market is characterized by higher highs and lower highs. Okay, if it is a sideways trend, you can see that the highs are on the same price level and the lows are also on the same price level. So a sideways trend is characterized by simply the highs and the lows. Alright, now for a downtrending market, you can see that every successive higher point is lower than the previous high and every successive lower point is lower than the previous low. So you can see that the downtrend market is characterized by lower highs and lower lows. Okay, now let us consider the price actions within the channel. The low levels indicate the point at which there are more buying activities to cause the price to move up. And at this low price level where more buyers buy to push the prices up is known as the support level. On the other hand, the high level of the channel indicates the point at which more sellers come into the market to push the price down. and this level is known as the resistance level. Alright, you see, when you're able to identify a channel on the chart, you can make out that whenever prices come down to hit the support level, it is more likely to bounce back up. So you'll be looking for buy entries at the support level. And whenever prices move up to hit the resistance level, it is more likely that it will bounce back down. So you'll be looking for some sell opportunities at the resistance level in the channel. But as I said earlier on, the trend is your friend. So for instance, if you identify an uptrending channel, then it is better to look out to make buy entries. On the other hand, if you identify a downtrending channel, it is better to look out for selling opportunities to increase your chance of making profits until the prices break out of the channel to take a different trend. When you identify that the prices are in a neutral trend, then you can look out to make buy entries at the support level, and you can look out to make sell entries at the resistance level. Wedges are chart patterns that assume the shape of a triangle. Prices can take patterns to assume the shape of an ascending triangle or a descending triangle or a symmetrical triangle. First, let us look at the ascending triangle chart pattern. The ascending triangle chart pattern forms a horizontal line of resistance, but the support levels keep ascending as the bulls keep putting in more buying pressure until the price wedges into an angle. At this point where the price has wedged into the angle, you can wait for the price to either break the resistance level or break the support level. If the price breaks the resistance level, it is a signal that there is going to be an uptrend, so you look out for buy opportunities. But if the price breaks the support level, it is a signal that the price is going to take a downtrend, so you should look out for opportunities to make sell orders. However, in an ascending triangle, it is more likely that the price will break the resistance level since there is more buying pressure that causes the support level to be going higher. Okay, then let's look at the descending triangle. This pattern forms a horizontal line of support, but the resistance level keeps descending as the bears keep putting in more selling pressure until the price wedges into an angle. At this point, you need to wait to see the direction at which the price breaks out. When the price breaks out of the resistance level, then you need to look out to make some buy entries. But for a descending triangle, it is more likely that the price will break the support level, because as you can see, there's more selling pressure that keeps the resistance level descending low. That's why there's high chances that the price will break the support level. And when it breaks the support level, then look out for appropriate levels to make your sell orders. Alright, now let us talk about the symmetrical triangle. A symmetrical triangle forms a descending levels of resistance and ascending levels of support until the price reaches the angle. Here, you can wait for the price to either break the resistance line or break the support line. If the price breaks the resistance line, it gives an indication for an uptrend. On the other hand, if the price breaks out of the support line, it gives an indication for a downtrend. Okay, now let us look at the head and shoulder pattern. When you identify the formation of a head and shoulder pattern, it usually indicates the possible change in trend. So if the market is in an uptrend and there's a formation of a standard head and shoulder pattern, you can see that the neck becomes the support level for the price that retraces from the left shoulder and the head. The price retraces back again after hitting the left shoulder level to form a right shoulder. This pattern is more useful when it forms after a long period of an uptrend. It signals to the trader that the trend is about to change for a downtrend, especially after the price breaks out the support level, which is the neck. On the contrary to the standard head and shoulder pattern, the inverse head and shoulder pattern is more useful when it forms after a long period of downtrend. It signals to the trader that the trend is about to change for an uptrend, especially when the price breaks up the resistance level, which is the neck. In a nutshell, if you apply some of these useful chart patterns in your trading strategy, it will help you to identify the trend. Also, when you use these chart patterns in confluence with other useful candlestick patterns, it will help you to allocate the right points to make your buy orders or your sell orders. Hello traders. Now let us identify some useful candlestick patterns and how we can apply these patterns in our trading strategy. Generally, when you observe the structure of the candlesticks and the patterns taken by 2 or more consecutive candles, it can help you to figure out the current buying and selling situation in the market. Upon looking at the structure and the pattern taken by 2 or more consecutive candles, you can determine as to whether the market is going to be bullish or bearish. Normally, candlesticks patterns are used along with our trading strategy as a confirmation as to go long or to go short. That is, they can help you choose the right entry point for a buy order and for a sell order. But before we move to how to identify and apply these patterns, let us look at the parts of a candlestick. The upper and the lower wicks represent the highest and the lowest price respectively within a particular time frame. For instance, if you are on a 1 hour time frame on the chart, then the upper wick shows the highest level the price got to within a period of 1 hour. The lower wick shows the lowest price level within a period of 1 hour. Again, if you are on a daily time frame, then the upper wick shows the highest price level within a period of 1 day, and the lower wick shows the lowest price level within a period of 1 day. Now, the body of a candlestick shows the difference between the opening price and the closing price. That is, for a bullish candlestick, the price opens at the lower level and closes at a higher level. On the other hand, for a bearish candlestick, the price opens at a higher level and then closes at a lower level. And the color tells you whether it is a bullish candle or a bearish candle. You can select your preferred colors to represent the bullish and the bearish candles from the settings on your trading platform. In this tutorial, I'm using green to represent the bullish candle and red to represent the bearish candle. Alright. Now, let us identify some of these candlestick patterns that give signal for a buy order. These patterns indicate the start and the continuation of an uptrend. It also gives a signal for the end of a downtrending market for an uptrend. Okay, let's begin with the hammer candlestick pattern. A bullish candle with a short body and a long lower wick, and it is followed by another bullish candle. The formation of the hammer candlestick pattern indicates that although there was a high selling pressure in the beginning, but later the bulls were able to put a higher pressure within a short time to push the price up. This higher buying pressure in a shorter time is an indication for an uptrend, especially when the next candle closes above the hammer candle. The bullish engulfing candlestick pattern. This pattern is characterized by 2 or 3 consecutive short candles, and it is followed by one long bullish candle that closes above the last 2 or 3 short candles. This is an indication for an uptrend, especially when the next candle closes above the bullish candle. The piercing line candlestick pattern. This is characterized by a long red candle followed by a long green candle, but over here you can see that the green candle closes more than halfway up the body of the red candle. This indicates a strong buying pressure since the price pushed up a little above the average of the previous short candle. The morning star candlestick pattern. This is characterized by one short candle which looks like a star in between 2 long candles. The next candle after the morning star is bullish. The short body candle, which is the star, shows that there's somewhat equal pressure between the bears and the bulls. The third bullish candle shows that the bulls were able to take over despite the strong selling and buying pressure. So to confirm this is an uptrend, you wait for the next candle to open a little above the previous bullish candle. The last bullish candlestick pattern I'm going to talk about is the 3 white soldiers. Here you see there are 3 consecutive bullish candles with every succeeding candle being longer than the previous one. The consecutive candle is a good signal for an uptrend, especially when this pattern is formed after a hammer or a morning star. Alright, now let us move to the candlestick patterns that give signal for selling opportunities. Bearish signal patterns are directly opposite to the bullish candlestick patterns. So first of all, let us talk about the shooting star. A shooting star is a short body candle with a long upper wick, usually followed by another red candle. This pattern indicates that although the bulls were putting in more buying pressure, but the bears eventually came in with a superseding pressure in a shorter time. That makes it an indication for a downtrend. Another one is the hanging man pattern, which is just like the shooting star pattern. But for hanging man, there is a short body with a long lower wick, which is followed by another short candle. Next is the bearish engulfing candlestick pattern. A long bearish candle closes below last 2 or 3 consecutive bullish candles. So for confirmation, you wait for the next candle to open below the bearish engulfing candle. Dark cloud cover. That's the opposite of the piercing line in the bullish candlestick patterns. With dark cloud cover, there is a long bullish candle followed by an equal sized bearish candle which closes at more than halfway down the previous candle. This pattern indicates a stronger pullback by the bears as the price drops lower than the average of the previous price. The evening star. One short body candle is in between 2 longer candles, but the third candle is bearish. The evening star indicates somewhat equal buying and selling pressure. However, the third bearish candle tells us that the bears has taken over the market, so it is a signal for a short order. For confirmation, you need to wait for the next candle to open a little below the previous bearish candle. 3 black crows. This is opposite to the 3 white soldiers of the bullish candlestick pattern. You identify 3 consecutive bearish candles with every succeeding candle being longer than the previous one. Price open at the position similar to the closing price of the previous candle. This pattern indicates a strong selling pressure for 3 consecutive periods. That clearly confirms that there's going to be a downtrend. Alright, now let us go to some candlestick patterns that indicates a neutral trend. The trend continuation patterns. Doji. 2 or more consecutive short-bodied candles with short wicks. The pattern indicates an almost equal buying and selling pressure that causes the trend to not take any direction. The spinning top. Several consecutive short-bodied candles of equal sizes with long wicks. This also indicates an equal buying and selling pressure causing the trend to be neutral. The rising 3 method pattern. 3 bullish candles in between 2 long bearish candles. the pattern indicates that although the bulls took over the market for 3 consecutive periods, but with not enough pressure to supersede the bears, the falling 3 method pattern. This is opposite to the rising 3 method pattern. Here, you find 3 bearish candles in between 2 bullish candles. It shows that although the bears took over the market for 3 consecutive periods, but their selling pressure couldn't supersede the bulls. It's another signal for a neutral trend. Before I end the lesson, take notice that candlestick pattern is best applied when it is used along with other technical analysis like chart patterns, usually as a confirmation to an established signal. Moreover, use candlestick patterns to confirm short-term trends. Hello, this lesson is on how to apply one of the most vital tools on the trading platform, that is the Fibonacci tool. Okay, so first of all, let us go to the brief history of the Fibonacci numbers. The Fibonacci numbers are numbers that was discovered by a 13th century mathematician named Leonardo Fibonacci. This is how he discovered the numbers. He started with 0 and 1. And he added the current number to the preceding number to get the rest of the numbers in the series. So that is, if you add 1 to 0, you get 1. If you add 1 to the preceding number 1, you get 2. When you add 2 to 1, you get 3. When you add 3 to 2, you get 5. 5 added to 3 will give you 8. 8 plus 5 will give you 13. And that's how the series were discovered by Fibonacci. So we call this the Fibonacci numbers. Now, there's something special about this series of numbers. At a point in the series, when you divide a number by the preceding number, you get 1.618. And it goes on like that. Even if you don't get exactly 1.618, it's something closer to that. And the inverse is 0.618. That is when you divide a number by the next number. For instance, when you divide 89 by 144, you get 0.618. Simply put, every number in the series is 1.618 times greater than the preceding number. The ratio of one number to the next number is 1:1.618. The recurring ratio is what makes the Fibonacci series of numbers very special. It is known as the golden ratio. Another mysterious thing about this golden ratio is that it appears in many dimensions of nature. For instance, when you compare the full height of a human body to the height from the navel to the feet, the ratio between the two heights is approximately 1.618. It also appears at different parts of our body, like the length from the shoulder to the fingertips and the length from the elbow to the fingertips. You know, there are 3 joints that separate our finger into 3 parts, and when you compare the length of the 3 parts of the finger, it is in the golden ratio. Not only in humans, the number of petals in most flowers are Fibonacci numbers. When you look at how the stem of a tree separates into branches, most of them are in the Fibonacci sequence of numbers. Now, this Fibonacci sequence of numbers can be used to construct what we call the golden rectangle. You draw squares using the Fibonacci sequence of numbers as the dimensions, and you make sure that these squares are attached together. After, you find out that the length and the breadth of the resultant rectangle is in the golden ratio. Then you continue to join the diagonals of each square in the golden rectangle with an arc, and this will create a spiral that is normally found in so many things in nature, like shells of animals, the pine cone, parts of our body, and even in the cosmos. Just to mention a few. This phenomenal ratio is also known as the golden section, or the divine proportion, or the golden mean, and it is denoted by the Greek letter phi. Since the ancient days, the golden ratio is used by some renowned artists and engineers in their paintings, and even in construction of some renowned buildings, applied in the construction of the Egyptian pyramids and many others. So it appears that the golden ratio is playing mysterious roles in different aspects of life. It is also applied in trading on the trading platform as the Fibonacci tool. It is featured with different levels known as the Fibonacci levels. In percentage wise, the 61.8 level is the golden level, and of course the midpoint is the 50 level. Now, when you take a number in a sequence and divide it by the second next number, for instance 55 and 144, the result is 0.3819, and in percentage that is 38.2. And then when you divide the Fibonacci number by the next third number in the sequence, the result is 0.2361, which is 23.6 in percentage, and that is the last level on the Fibonacci tool. So in this lesson, we are going to learn how to apply these vital levels on the Fibonacci tool in trading along the trend. When price is in an uptrend, there's an impulsive movement of the price to get a higher high level, and then it retraces back to a higher low level before it goes back to a higher high level. That's how we identify an uptrend. And the opposite is for a downtrend. In a downtrend, the price will make an impulsive move to a lower low level, and then it will retrace back to a lower high level before it goes back to a lower low level. So the question is, how do we apply the Fibonacci tool in trading along the trend to make our chances of winning very high? The first step is to identify the trend, and we know how to identify the trend. An uptrend is characterized by higher highs and higher lows. The opposite is for downtrend. A downtrend is characterized by lower lows and lower highs. Okay, now let us look at how we can apply the Fibonacci tool to trade in an uptrending market. After you've identified an uptrend, you need to draw a Fibonacci tool to connect the extreme low and the extreme high of the first impulsive wave. Next, we target the price to retrace back to a brighter Fibonacci level so that we can buy again. After the first impulsive wave, the price is likely to retrace back. So when it retraces back to the golden level, that is the level of the 61.8, there's high probability that the price will bounce up again. What really matters is when price retraces back to the level, do you find a confluence? Do you find some bullish candlestick patterns occurring at that level? Then yes, it is likely that you are going to win the trade when you enter the buy. Okay. Yes. Now let us look at how to apply the Fibonacci tool in trading in a downtrending market. It goes just like the uptrend, okay? But when you identify a downtrending market, what you need to do is to draw the Fibonacci tool to connect the extreme high and the extreme low. And after that, you wait for price to retrace back up to the vital level like the 61.8 level, 50 level, or the 38.2 level. Then you look out for the confluence with other factors like the bearish candlestick patterns. In a nutshell, first of all, you need to identify the trend, okay? After that, you look out to identify the extreme high and the extreme low point and connect these points with the Fibonacci tool. Next is to wait for retracement back to the vital levels like the 61.8 level, the 50 level, or the 38.2 level. And the last step is to make sure that you find the confluence with a candlestick pattern, okay? So if it's in an uptrend, you look for an uptrending candlestick pattern or a bullish candlestick pattern. And when it's in a downtrend, you look out for a bearish candlestick pattern as a confluence to enter a sell order. Yes, if you focus on these steps, it can be a profitable trading strategy for you. Now let's look at some trading examples with the Fibonacci tool on the chart of a trading platform. Remember, it is always better to trade along with the trend. That is, as a way to have higher chances of winning the trade. When the market is uptrending, you look out to make only buy trades. On the other hand, when the market is trending downwards, you look out to make only sell trades. So the first step is to identify the trend of the market on the chart. How do you identify the trend? You do that by locating the extreme high price point and the extreme low price point. On this chart, we can see that the points make higher highs and lower highs, and that indicates an uptrending market. Since it's an uptrending market, we look out to make only buy trades. The next step is to use the Fibonacci tool to connect the extreme high points and the extreme low point of the first impulsive move. On the trading platform, select the Fibonacci tool from the list of objects on the toolbar and drag it to connect the high and low points of the first impulsive move. Step 3. Wait for the price to retrace back to a vital Fibonacci level, most especially within the 50% to 61.8% level. Here you can see that the price retraced back to the golden level, the 61.8% level. Now, after the price has retraced back to a vital Fibonacci level like this, we need to look out for a confluence or a confirmation to enter a buy trade. Here on the golden level, we can see the formation of a hammer candlestick, and next to it is another bullish candle as a confirmation to enter a buy trade. The confirmation here is to wait for the next bullish candle after the hammer breaks up above the previous high. That's the right point to enter the buy order. And yes, the prices went up above the entry point, so it was a profitable trade with the Fibonacci tool. Take a look at another trading example. Step 1. Starting from the beginning of the chart, we need to identify the trend by locating the extreme high price point and the extreme low price points. We can see these make higher highs and lower highs, meaning the market is uptrending. And since the market is uptrending, we need to look out for buy trade with the Fibonacci tool. Step 2. Let's connect the extreme high price points and the extreme low price point of the first impulsive move with the Fibonacci tool. After that, you wait for the price to retrace back to a vital Fibonacci level, around the 50% to the 61.8% levels. And the last step, a confluence or a confirmation. You can see a hammer candlestick, and the next to it is another bullish candlestick. This is a confirmation to enter a buy trade. And yes, it was another profitable buy trade with the Fibonacci tool. Also, you can see the prices retrace back again to the golden level where you can make another buy trace to make profit. Okay, now let us look at a short trading example or a sell trading example with the Fibonacci tool. On this chart, first you need to locate the extreme high price points and the extreme low price points to be able to identify whether the market is trending up, down, or sideways. You can see here the extreme points make lower lows and higher lows, meaning it is a downtrending market. So for a downtrending market, you look out to make only sell trades. Step 2, we connect the high point and the low point of the first impulsive move. Next, you wait for price retracement back to the vital Fibonacci level, and you enter a sell trade after you see the formation of the bearish candlestick pattern. You can see here an evening star followed by another bearish candle. Yes, this is the right point to make the sell order. And this was a profitable sell trade with the Fibonacci tool. Alright, that is how to trade with the Fibonacci tool. Most traders use the Fibonacci tool trading strategy together with other trading strategy. Mostly, the Fibonacci tool is used to identify vital points to make a buy or sell order in a trend. It is not 100% guaranteed that you are going to win all your trades when you are using the Fibonacci tool, okay? But all it requires to be successful in trading is to have a strategy with above 60% win rates and a proper risk management plan. Have a golden trading experience with the Fibonacci tool. Thank you. Hello traders, this lesson is about the use of technical indicators. In this lesson, I'm going to explain the two main categories under which technical indicators are used, and then I'll go ahead to explain further how to use some of the most important technical indicators on the trading platform. So let's get started with the meaning of a technical indicator. A technical indicator is a trading tool made up of automated mathematical calculations based on price and volume data from the past. Technical indicators are used by traders to visualize price data from the past and based on that to predict future price movements. Technical indicators are applied in the trading of commodities such as Forex, stocks, cryptocurrencies, indices, among others. Before you apply a technical indicator on your trading system, you need to understand the mathematical formula behind it and understand how it works. There are thousands of indicators in the market. However, have in mind that there is no one indicator that is 100% accurate for price prediction. Based on their functionality, this large number of indicators can be put into two main categories. And these are the momentum indicators and oscillating indicators. So that means an indicator can be performing a momentum function or oscillating function, and some indicators even perform both the momentum and oscillating function. So what is a momentum indicator? Momentum indicators help traders to identify direction of price breakout from a non-trending market. Examples are the moving average convergence and divergence, that is the MACD, Bollinger Bands, average direction of the index, that is ADX. Now, oscillating indicators help traders to identify the overbought and oversold levels, more especially in a ranging or neutral trending market. The percentage level of accuracy of oscillating indicators reduces in a trending market. Examples are the Relative Strength Index, popularly known as the RSI, the Stochastic Indicator, just to mention a few. Like I said, some indicators can be used for the purpose in both categories. An example is the RSI indicator. It performs a major function as an oscillator, but it can also be used to determine the momentum of the market. So in all, understanding how an indicator works is the major key. Alright. I'm going to discuss some commonly used indicators and how to apply them in your trading system. First of all, let us talk about the volume indicator. The volume indicator is simple to understand and easy to use on the trading platform, yet it can be very useful to determine the price momentum of a commodity in a short time. It simply shows you the level of high or low amounts of transactions on a commodity. This means the more money is transacted on a commodity, the higher the volume will be. And these are represented in bars on the trading platform. Quickly, let us look at how you can use the volume indicator in your trading system. It is simple and can be very useful when the market is in an up or downtrend. That is, if the price takes a particular trend, you can look at the volume to determine how far the trend can go. To explain better, when the price takes an uptrend and the volume indicates a higher level, it gives an idea that there have been more buyers than sellers, and as the traders like to go along the trend, there will be high probability that more buyers will enter the market to push the price further up. On the other hand, when the price takes a downtrend and the volume indicates a high level, it gives an idea that there have been more sellers than buyers on a highly transacted commodity. As a result, there is high probability that more sellers will enter the market to push the price further down. But know that the volume indicator is best used to predict short-term momentum, not a long-term momentum. Alright, the next indicator I'm going to discuss is the moving average. When we talk about moving average, it is the average of the historical price for a number of periods. For instance, when you select the 60 moving average indicator, it shows you the line of the continuous average prices for the past 60 periods. Moving average is one of the commonly used indicators in the market. Knowing the average value is important to filter out the noise from the random price movements. Moving averages can be used to identify trends and also confirm price reversals. Basically, when prices are above the moving average indicator, we consider it as an uptrend. On the other hand, when prices are below the moving average line, we consider it as a downtrend. Also, when prices break the moving average line, it implies a trend reversal. Some traders also use the moving average line as support and resistance. Thus, when prices are above the moving average line, it acts as a support level. Conversely, when prices are below the moving average line, it acts as a resistance level. So, moving averages can tell you whether prices are trending up, down, or is ranging. It can also tell you the level of momentum of a trend. But remember, none of the stated uses of the moving average indicator is 100% accurate. Of course, no indicator is 100% accurate. Now, let's look at the three main types of moving averages. We have the simple moving average, or the SMA. We have the weighted moving average, WMA, and the exponential moving average, EMA. First, let me explain the simple moving average and show you how it is calculated so that you can, based on the understanding, to adjust according to the market circumstance. If you select the 10-period simple moving average, in other words, the 10 SMA on a maybe 1 hour time frame, the indicator adapts the closing prices for the last 10 hours and divide by 10. This calculation is done after every hour on the past 10 periods. The new average price point is then connected to the continuous simple moving average line. For this, you need to understand that the more the simple moving average periods, the more it lags behind, and the slower it responds to rapid price fluctuations. That must be important, especially during the most current period. Conversely, the weighted moving average and the exponential moving average functions to give more emphasis to the recent periods, so it gives more details about what traders are doing at the moment. However, that does not make the weighted moving average and the exponential moving average any better than the simple moving average. Each of them can be useful or not, depending on the objectives of the trader. Now, understand that because the weighted moving average and the exponential moving average give more emphasis on the most current period, it may not be appropriate for a trader who wants to have a bigger picture of the overall average from the past. They quickly reflect a shift in the trading sentiment with regards to the supply and demand, or the important news events that influence the price of the commodities. To demonstrate the difference between the functionalities of the simple moving average and the exponential moving average, when you plot both of them on the chart, you will see that the exponential moving average is closer to the prices than the simple moving average. Alright, let me give you some important tips for using moving averages for more successful trading. For the number of periods to select for moving averages, use 10 to 20 periods to identify short-term trends. Use 50 to 100 periods to identify mid-term trends. and then use 150 to 200 periods to identify long-term trends. As to when and how to use which type of moving average indicator depends largely on your objective and trading system. Use exponential moving average for shorter time frames, or if you're analyzing a fast moving market, because it will give you more emphasis on the latest prices. Use the simple moving average indicator when you are planning on holding a position for a longer period of time, as the exponential moving average can be too sensitive to give you early fall signals. You should also use the simple moving average if you look to filter out the noise around rapid price fluctuations to be able to determine the overall market direction. Now, let us discuss about the MACD indicator. MACD stands for Moving Average, Convergence, and Divergence. The default formula of MACD is stated as it is in this example. MACD 12, 26, close 9. I'm going to explain that. And after you understand what those figures stand for, you can make changes in the settings to suit your own trading system. The blue line represents the MACD line. It is calculated by subtracting the past 12 periods moving average from the past 26 periods moving average. That is why it is stated 12, 26. The orange line is called the signal line. It is calculated by dividing the past value of MACD line by 9. This is how the MACD line and the signal line converge and diverge. As the value of the MACD line increases, the distance between the two lines spread or diverges away from each other. But as the value of the MACD line decreases, the two lines come close together, or in other words, they converge. The convergence and the divergence is illustrated on the MACD histogram. So the histogram gives a picture of the area of convergence and divergence. Simply put, convergence is when the difference between the two lines gets smaller and get closer together. Divergence is when the difference between the two lines gets bigger and gets further apart from each other. You can see that the two lines cross over from time to time. We call that the MACD crossover. Traders use the crossover as a signal of momentum. That is, when there is a crossover, there is high probability of price movement in up or down direction. So it is either a momentum for bullish signal or a momentum for a bearish signal. A bullish momentum is when the MACD line crosses above the signal line from below. On the other hand, a bearish momentum is when the MACD line crosses below the signal line from above. Since MACD is calculated from moving averages data, it lags behind price. So it may not be best indicator to determine long-term trend, but it is better to determine short-term trends. Now, let me give you some tips on how to use the MACD indicator for more successful trading. Use the MACD indicator on higher time frame to determine the current trend. Then, look for trade setups in that particular trending direction on a lower time frame. Example, if you are trading on a 1 hour time frame, then you look out on a 4 hour to daily time frame to catch the current trend with the MACD crossover. When you are on the higher time frame, if MACD line crosses above the signal line, then you go back to lower time frame and look for long opportunities. On the other hand, if the MACD line crosses below the signal line, then go back to your lower time frame and look for short opportunities. Here are some trading examples with the MACD indicator. Alright, now let's discuss the RSI indicator. RSI stands for Relative Strength Index. It measures the ratio of the up moves and the down moves to indicate the overbought or oversold signals. In an overbought situation means the price has risen more than expectations, so there must be high probability of price to move back down. When there have been more buyers in the market for some period of time, they would like to sell back to take profits. So when traders identify the market in an overbought situation, they look out for selling opportunities. Oversold means the price has fallen more than expectation, so there is high probability of price to go back up. This is because when there have been too many sellers in the market for some time, they are likely to close their trade by buying their positions. So when traders identify an oversold signal, they look out for buy opportunities. The mathematical formula of RSI has two parts. First, the relative strength, or the RS, is calculated by dividing the average gains for n periods by the average loss for n periods, where n is the number of RSI periods, and it can be adjusted by the trader. For example, if you set the number of RSI periods to 30 days, then the relative strength value will be the average gain for the past 30 days divided by the average loss for the past 30 days. The second part is about converting the RS value into an index number, and this is the formula for doing that. On the trading platform, the RSI indicator is illustrated as a single line of scale from 0 to 100, with an overbought line at the top and oversold line at the bottom. In all trading platforms, the default level for overbought is 70 and the default level for oversold is 30, but you can adjust these levels to your preference. For example, I like to use the 80 for my overbought line and 20 for my oversold line. It appears the more you expand these two levels, the less signals you get, but the more accurate it becomes. Note that during periods of strong uptrend or downtrend, the RSI may remain in overbought or oversold situation respectively for extended period of time. Here is how you can use the RSI to identify trend reversals. In an uptrending market, RSI remains at the 45 to 90 range. In that case, when the RSI breaks the 45 to 55 zone and heads lower, it indicates a potential downtrend. Also, in a downtrending market, the RSI remains in the 10 to 55 range. In this case, when the RSI breaks the 45 to 55 zone and heads upward, it indicates a potential uptrend. So, the 45 to 55 zone of the RSI indicator is usually used as RSI support zone in an uptrending market and as a resistance zone in a downtrending market. Another vital way to use the RSI indicator is by your ability to identify RSI divergence. RSI bullish divergence is when price forms a lower low in the price chart, but RSI forms a higher low in the RSI chart. This indicates that the price would bounce back and go up. On the other hand, RSI bearish divergence is when price forms a higher high in the price chart, but RSI forms a lower high in the RSI chart. This indicates that the price is likely to pull back and go down. So that is how you can use the RSI divergence to identify a buying signal or a selling signal. Now, before I end this lesson on the use of technical indicators, I want to give you some general tips for using indicators for more successful trading. The best ways to use technical indicators. Because most indicators are lagging, they should always be used as a confluence. Or when I talk about confluence, I mean they should be used together with basic price action, that is chart patterns, candlestick patterns. Meaning you need to place your main focus on the price action and use indicators as a confirmation. Some profitable traders don't use indicators at all, only price action. Every indicator is designed to perform a certain function, so using only one indicator as your overall trading strategy can be very disastrous. Combining indicators is a great way to improve your edge in the market and give you more confidence in trading, especially if the combination is of both momentum and oscillating indicators. However, it doesn't mean the more indicators you use, the better edge you will have in the market. Using more indicators, usually more than 3, can actually get you confused by putting you in a state of analysis paralysis. And remember, the best way to be profitable in trading is to practice. So you can practice along with some of the indicators we've talked about today. And thank you for your time. I wish you successful trading.